Hey, it's Rick. It's Tuesday afternoon, a couple of days into the week. It's sort of time to see where we're at after my recap last weekend. So we start with the S&P 500. As usual, we have the weekly here on the left and the daily on the right. I had drawn out this a week ago, tomorrow, last Wednesday. I drew out these lines, um, thinking this might happen, sort of a gradual pullback to the 21-day moving average, and then hopefully would hold there and then lift off from there. And it seems to be holding out. Not quite exactly the plan, but I like this action so far. It's kind of cluttered though with these those average that stuff on there, so I'm going to take them off. It shows up better on the weekly chart over here. We ran up here, consolidated, another big run up, stalled here, and then we've had a couple of sort of narrow days. So if we stay the week like this is a good thing. It gets this moving average time to sort of start moving up. And even a couple of weeks basing in here would be a good thing. But there is something that you should be aware of. If you notice this action here on the S&P, we're pretty flat. You know, we're in a tight range. But if you look at the equal weight, the S&P 500 on an equal weight basis and not market cap, you see that it's showing much more strength. So in the S&P 500, the top five big companies, like I've got them here, Apple, Microsoft, Tesla, NVIDIA, and Amazon, account for roughly 20% of the S&P 500. And then the rest, the other 495 companies, are outperforming. And shows up even more pronounced when you look at the NASDAQ 100, because these five companies, Apple, Microsoft, etc., take up about 45% of the QQQ's weighting. So it's that index is heavily dominated by these mega corps. So if we look at the Qs, you know, we're still operating in this box here. It's pretty flat. But when you compare it to the QQQE, equal weight, it's a stronger picture. That just leads me to be somewhat more bullish. I'm starting to load the boat a bit, especially if we look at the small caps. They haven't broken out of this box here yet, but we reached a level we haven't seen in a great number of weeks, since all the way back here to beginning of March. So that's a good sign when the small caps and then the mid caps are moving. So the mid caps have actually shown even more strength. They've come out of this little basing area here and are going higher. So what's propelling all this is I think this is a good sign. What's propelling all this is money's coming out of things like Apple. You look at Apple is on a 6 days straight down now. Microsoft, 3 days down. It got some support today, but you see this trend is quite different. Tesla, I think it's holding up a bit better, but I had 5 days down. It sort of did nothing today. And then NVIDIA, it's just flat. So you get the idea. So the money is rotating. It's not going out of the market. It's coming out of these big boys and being plowed into the mid cap and small cap companies and other S&P companies. So this is actually a really good sign. I don't play in, you know, my playground is not the NVIDIAs and Apples and Microsofts, and they're just way too big and too many players. They're too over-owned by all the institutions. So although I mean, you get NVIDIA has been the poster child for this year. It's tripled since beginning of the year. January it was at 150, and now we're up close to 450. So you can get lucky in these things, but that's just not my playground. It's a different story with Toronto. The XIU, we are still in this box. And if you go back a year, you go back to July of, this is July of 2022, we're no better off price-wise. Draw a line here where we closed on, this was July the 25th last year, and we're at the same price. So the Toronto market has really underperformed over the past year. Now, again, I do see some signs of life. If you look at the individual sectors, there's, financials are starting to come back. Energy is starting to come back. And so these are the main drivers of the Toronto Exchange. And I think they account for over 25 or 30% of the index. So there is some hope here. I trade this by way of the double leveraged HXU, which I have a position I think I've talked about. I got in way down here and sort of what I would call a bottom fish, not my normal style of trading whatsoever. Really a bottom fish kind of trade with very low risk. I mean, it was like less than a 1%. I think it was a 1% stop. And at last count, it was up. I don't know. At one time, I think it was up around 15%. I didn't sell it in here when I had wanted to. We had this gap down, so I still own this one. But I am when I get to the Canadian part of my portfolio, and show like I'm only 52% invested, I think, in my Canadian account. I think tomorrow the announcement comes out on interest rates. So depending what happens with the market tomorrow on Canada, I will probably put the balance of my cash into the HXU with a stop, unless it goes below this price here. The stop would be 17.98. So if it goes below that, then all bets are off. But if it stays above that, I'll probably put the rest of my account into the HXU with a stop under here. So right now, if I got in at 18.15 where we are today, that's less than that's about a 1% stop. So I think I have got about 25,000 or 30,000 of buying power or more in that account. So I risk $250 for a potential big lift. So that's sort of my strategy for that tomorrow. Wanted to show you this exposure tool that I built, which really helps keep me. Let's expand this out a bit so you can see it a bit more. Let's just. So in here, I track each of the holdings, and again, I only update this. I don't think I've updated this since I first created it about 10 days ago with you folks. So this is the first real update. But again, we do the unit that we're buying, when we bought it, what the price was. You see the top part. Where it is today, how many shares I have, where's my stop, what's my stop percentage, and then what's my exposure. So HXU, their first purchase was at 17.58. Stop has been raised to 17.58, so it's break even. So there's no exposure whatsoever. West Shore Terminals was bought at 30.55. It's up to 31.80. Again, I raised the stop to 30, my original entry price, so there's zero risk. In fact, I think tomorrow I'm going to raise the stop in that even up higher at around 31 or $31 in that zone. Guarantee a profit. And then London Mining was in at 10.43. It closed today at 10.96. We're up over 5%. So at a minimum, I'm going to put my stop at break even. So right now with a full stop, I'm risking $416. but I'm going to change the stop to 10.43, which is my entry cost. And now I have zero exposure. So, and this is what you want to be, is 3 or 4 open positions. If everyone stopped out, you're not going to lose any money. And you can, if you have buying power, then you can comfortably add another position or even 2. So same thing on the US side. I'm more invested. I think I'm 82% invested. And again, these stops are going to get raised. CRM gapped up today. Just pull that up. CRM had, you love to see this, gapped up and then held the price all day, closed near the highs. So you gotta love to see that. The other big win today was Dynatrace. My entry was, can't remember which day I entered now. Must have been right here. And it's up very nicely. It's up almost 4% today. And then FTNT, which is my largest holdings, is up, getting close to my 12% price target. The old Rick would have sold this or sold a major part of it by now, because it's up. Where's that? FTNT is up 8.2%. So this is way more than my normal gains from my trading account, but I'm trying to be thinking like more longer term. I do have a big chunk of this in my trading account as well, and I did sell a small piece of it, but I still have 2/3 of it left. So yeah, it's been a good week so far. Yeah, I think I said in the email my Canadian account's up like over 2%. The US account's up over 5%, and my trading account, which I don't report on, is up 8.5% in the last 2 weeks. So in the last 2 weeks, I've completely erased the loss from last year. So this is what can happen quickly and hopefully sustainably when you get into so-called easy dollar environment, when things get much easier to work with. So let's hope this stays for a while. So this tool is really very, very useful. Just as an example, see, the US side shows that I have 1.7% portfolio exposure. But with the gap up on CRM today, I'm going to raise my stop tomorrow to break even. So 212.59 takes the risk out of that one. And Dynatrace, of course, it's up bigly. So take my original stop, I'll put it to break even. And now I have zero risk across my entire portfolio, which is precisely where you want to be. So that's that. Not much else to cover over. I say I'm going to take a close look at HXU tomorrow, depending what happens in Canada. I don't have a lot of buying power left on the US side of things, at least for the longer term, but I'm going to be like super picky. That's the other thing that I will talk about in a future sort of essay, is what's the optimum number of positions. And I feel it's 4, maybe 5, depending on the size of the account. I mean, if you got a $5 million account, or 4 million, let's do easy math, $4 million account, having only 4 positions of $1 million each might be scary for some. But that's the way you really grow your account, is by being more concentrated. If you're going to have 20, 25 stocks in your portfolio, you're just going to end up doing as well as the market. You may as well just buy the SPY. Okay, so have a good evening, everybody, and I'll give you an update in a couple more days. Cheers.